We're good to go. We've got 24 and more are coming in.
I'm going to share my screen to just show everyone the agenda. It's going to be a very good agenda. So pretty much I'm taking over as the IBD meeting host right now. Floyd has done 16 years as the Alaska IBD host. Floyd is going on to new ventures, becoming a full-time trader and doing more of that, but also his engineering consulting work.
Yeah, trying to be an engineer at the same time.
Oh, man. From one mechanical engineer to another. But Floyd is definitely going to pop in once in a while. I'm definitely going to need his help. And definitely appreciate all of you guys being here. What's up, Rick?
I think the last piece for you to take over is the emails. You'll be taking over the email updates now. Floyd writes such great emails. Tough shoes to fill.
I'm Youngs, and I'm in San Francisco. I'm going to take every single article that Floyd has ever wrote, input it into ChatGPT, and see if I can make something similar.
All right. Wow.
So it will be like Floyd has never left because we're still talking to him every single day.
Yep.
Writing in Floyd's voice.
I see someone named Amy here. Is that our Amy or a different Amy?
It's a different Amy.
Okay.
What?
I know you, Amy. I think I know you. We met at the meetup in San Francisco.
Yeah,
Maybe.
possible about that. Maybe there are so many Amy's.
That is true. That voice sounds a little familiar.
I was in San Francisco, but it may not be the same time. You say Floyd is going where?
Floyd is doing more trading and he's concentrating on his engineering job a little bit more. So he's not going anywhere, honestly. He's going to be in Alaska, just as always. And he's going to pop in as a guest speaker and pop in as, hey, I've heard bad things about Haley. He needs to kind of whip it together.
I think people were getting tired of me and we needed fresh young blood. And here he is. His name's Haley.
You're still our backbone.
He definitely is. Something that'll continue is the monthly performance update. I've made it my goal. In about 2 weeks, I'm going to finish learning the system through and through. And every single meetup meeting, I'm going to give everyone an update. Where was the buy signal? Where's the sell signal? What's going on? And I'll also show everyone what I'm doing with my own personal portfolio.
Wow.
This meetup is for educational purposes only. Any recommendations to buy or sell does not constitute some trading actions, and we're all volunteers. We don't get paid for any of this. So please don't sue me. Please don't sue Floyd. Please don't sue IBD. We're just here as volunteers, and we're just wanting each other to meet up and talk about stocks. Let's start with poll number 1.
Can I even know those alcohol swaps, please?
Oh, I'm going to mute you, Ralph. Oh, so Ralph is the Walnut Creek IBD meter. IBD meetup leader. So Walnut Creek's over east of San Francisco. So let's start with poll number 1. Where are we all? Are we in Ireland? Are we in the Philippines, California, Texas, New York?
Am I launching this one or are you?
Could you launch it, Floyd?
Yeah, I will launch it right now. Where are you tonight? You see that?
Oh, there's like a little auction, right? It's like, hey, we have another one in Pacific, another one in Alaska, another one going to Eastern time. There's still one, but we're getting a lot of people in Eastern time. So hopefully everyone has a good dinner before joining us in the call today.
Yeah, we need a few more to click in. We've got 68% have voted so far. We have 31 attendees right now. So let's get a couple more to click on where you are tonight.
We have about 8 more people to click on to see how we're doing.
Yeah.
We got another. So is there any, while the last 8 people are clicking, is there any burning questions that anyone wants me to answer tonight?
Are you going to have an agenda for each meetup?
Yes, I will.
Are you going to post it somewhere, or can we ask for an agenda?
So feel free to ask. Feel free to hey, you're a young buck. Please be more consistent. I don't mind.
We get in contact with.
So we're talking to Amy Smith right now, and during the next month, we're going to start rolling everything over to one of my emails. I'll probably copy Floyd and I'll have a own separate email for this group. I'm most likely going to do a Google group, so that's a lot easier to just keep in contact with each other and have relevant topics. It's been pretty effective in keeping on the same topic, depending on which conversation we're having.
So why not leverage Meetup group community? Like it already has that feature.
Let me explore that one. I haven't used it before. Let me explore the Meetup community feature. Hopefully that'll make things easier.
So you see the poll results?
Oh yeah.
So there's 2 of us from Alaska, and it's pretty incredible that the East Coast and the West Coast are tied at 36%. That's pretty amazing.
That is pretty amazing. And we have one more neighbor of yours that's joining in from Alaska. and 5 more Central Time. So let's go ahead and launch our next poll. This is always the burning question every single time. What percent invested are you in the stock market? Are you 10%? Are you 20%? Or are you maybe even 100%? And we'll find out. So Floyd and I both can't vote since we're the hosts. I'm currently 101% invested. So I'm technically more than 100%, but that 1% is because I just wanted a round number when I bought my stocks. I'd rather go over 100% because I'm pretty bullish on the market since the market has been a little bit slow. We're off the lows. We're at a 50% retracement from the highs to the low. And we have about 80% participated already. And looks like there's someone besides myself who's more than 100% invested. Generally speaking, I'll wait until 1 or 2 more people so we can just get a few more rounds before I share the results. Seems like majority of us are pretty well invested inside the market. I would say 90% of us are invested.
Yeah, I'm just going to share it then.
So there's the results. This looks like a bell curve, right? It's the little tail end on both sides, and the peak support is 60%. So generally speaking, so we're not really overly bullish. We're not overly pessimistic right now in our meetup group. We'll see what ends up happening. Anyone have any comments about how they're invested? Cool. Then moving on. So I'm going to go through the big picture to see, since we're an IBD group, I always like to go back to IBD. What percent invested are we? I'm going to switch my screen share. We're going to see what exactly has been happening. Our group is about 40 to 60% invested, and that's what exactly IBD's exposures are. Does anyone want to share what they're buying right now to get to the 40 to 60% invested?
Pins.
Pins. P-I-N-S?
So shampoo, the
Literally, this guy that's number 1 on IBD 50. Him.
yes.
I'm going to make a little note of that, and we're going to look at that chart a little bit later.
For me, my 43% invested is almost all QQQ and SPY, the boring stuff.
We're going to look at TQQ and SPY. I'm also going to do a comparison later of Russell 2000 to the NASDAQ right now. But I think there's been something interesting going on in the past month because I always believe in regression to the mean, meaning if there's underperformance, you'll most likely start going to overperformance.
Interesting. Cool.
But that's the stock side of me talking. That's the statistician inside me talking. So as you guys all know, today is an interesting day. We started out pretty high and then we went even higher to close a little bit lower. So we're probably at a 50% retracement today. So what's like a stalling day? And what IBD says is the market pulse. Small caps are leading. So that's why I really wanted to compare IWN and QQQ. And our exposure is probably about 40 to 90. There's one distribution date only on the S&P 500, not on the NASDAQ, because they follow both. And there's leaders up in volume and down in volume. Was anyone in any of the leaders that were down in volume? If so, what happened? Did you do anything or did nothing? Cool. So let's take a look at a few charts since that's my favorite pastime. Right, I'm going to switch my screens. So someone has invested in HIMS. We're going to see how this is going. Actually, let me look at the bigger picture first. The bigger picture is the indexes. How is NASDAQ doing? You see a bunch of lines in my graph. Can everyone see this graph or do you guys
Yeah.
want me to zoom in?
Yeah.
Okay, I'll leave it at this for now. I always like to draw a bunch of horizontal lines to see where's previous highs. Are we hitting it? Imagine this high that grew in 2022 got retraced in 2023. So that's why I always like these lines. And this lines is like, hey, it's probably not relevant anymore. Same thing with the high in 2021. I followed it over in 2024 and now it became more of a support. And even these bottom prices, it looks like support. But how is the market? From high to low, we're about 50% there. We're still below the 40-week moving average. So it's not a complete bull market, which is shown by our portfolio. But how does this compare to the laggard right now? And the laggard, I always say, is the Russell 2000. This guy just hit above the 50-day moving average. Oh, hey, I'm going to peek up. Oh, no, I don't really like going above the water. You know what? I'm going back underwater until today happened. But hey, I'm going to try again. Ignore the volume here. This is IWM. And this doesn't matter because it's the ETF and not the actual indexes. The one thing I wanted to show you guys that was interesting today is this. So that's IWN. And I'm going to do QQQ. And what I'm going to do is not a 1 year trace back, but I'm going to do about 1 month. Oh no, it is the 11th, but I'm in the wrong year. So in the past month, there has been a slight overperformance by IWM by about 2%. So I'm really keeping a close eye on this because if we're doing the LETF strategy, we want to find out what ETF should we buy that would outperform even more besides just the QQQ. So this QQQ is slightly outperforming by, let's say, about 1% of IWM. The reason I did 411 instead of 48 is because on 48 there was a huge underperformance on IWM. I think it was like 2.5%. And that was right at the bottom of the chart. 2.6% was IWM. And we go back to QQQ. That day wasn't so bad. It was negative 1.8. But afterwards, near the bottom, IWM started to outperform.
But have you done the same analysis going back to 2018, 2020, and when market took a dive like this? Did IWM perform better than QQQ going forward? Because looking at hindsight, as you just said, you picked the right date just so that IWM did better than QQQ. You just make it one day off and things will be different.
That is true. So let's take a look at 2016 right over here, 1103. So that's ID. It's interesting. Something similar happened in 2016 too, where in a 1 month period since the low of the, whoopsies, I'm a little too trigger happy with my keyboard, where IWM does slightly outperform, but this one's actually an even larger outperformance, and QQQ seems to have went sideways. Let's look at this chart really quick. So 2016 here, and it really outperformed until a month, until then went sideways. Let's see what happens with QQQ. It went sideways first, and then it started going up. Interesting. Yogesh, what do you think of this?
Behind the, if you do it by looking at the chart and you nitpick the days and stuff, then the way human behaves is we will always pick the day that it works best for our results. So we will end up doing the bias always.
Confirmation bias.
Yes. What you're assuming here is if IWM performed better for the first month, it's going to perform better for next 4 or 5 months or next year. That's the base assumption you're using from this 1 month performance.
Yes.
That may not be true.
That is correct.
Then the issue is that you cannot build a model based on it because it will not give you what you are looking to do to pick up the right ETF in the triple leverage ETFs to give you the best outcome.
I have to look at more of a look back period if it's underperforming before, because I just picked a random date in 2016.
And in most cases, you will find that the first month or two, IWM does better.
Yes, that's what it's looking like.
So then if the market goes down by 20%, would you put your money and bet on IWM first? Assuming that is the bottom. And if it's not the bottom, what happens next?
That is true. That's a very good insight, Yogesh, because it might go up for the next few months, but based on my gut.
What I prefer to do is use a system. You can use any kind of indicator or something that the system is based on. So that way we remove our bias. It doesn't matter what my gut feel is or what I feel about the chart. If the indicator is beyond a certain level, you take the position. If it goes below a certain level, you get out. So that way it removes that bias component to the system.
Very true. Rick, you raised your hand.
Just looking, so that's maybe to give you the benefit of the doubt a little bit. If the thesis is that the bottoms, like in the next month after a bottom, it can be investigated, right? It can be studied, like you look at bottoms, 20% drops or more, 15% drops or more. From the bottom, does IWM outperform QQQ over the next month or two? If that's a thesis, you can study it objectively and go back for 10 years or 20 years and see if there's a pattern. Don't know if I'd want to trade that or put my money on it, but it's interesting if that holds up. I did a comparison of that for the bottom in October 2023. We had those 3 waves down in the middle of 2023. IWM did outperform QQQ by a pretty good amount over the next 2 months from 10/27 through 12/27. So it's an outperformed at 26% to 19%. Interesting, maybe worth more study.
Yep.
But I think Yogesh's points were right on. That's always, we got to be always watchful for our own confirmation bias.
I'm just taking notes. So I think that'll be a fun study for me to do, where you just compare 20% bear markets and seeing how IWM versus QQQ is. And I think that'll be a fun presentation too.
That's cool. That's right up my alley. I'm a statistics kind of guy too, and number
Right,
crunching
but
guy.
it's a good presentation. It's a good research article. The real insight or the real value would be, can you identify the bottom? If the market is down, let's say your threshold was anytime market goes down more than 20%, if that's the threshold, or 15%, whatever threshold you come up with. If you assume that this is the bottom, then you should take an entry in IWM and it tends to perform 10% better than QQQ for next month. So that's a tradable method, I would say.
Yeah, that would definitely be tradable because it's like there's historical precedents,
Yep.
but does not mean that it's going to repeat itself, but it'll be highly likely.
Correct.
George, you had your hand raised?
Yes, can you show the very first chart you showed of QQQ?
Very first chart I showed. Was it the one I showed in the comparison chart
No, the very beginning.
in 2016?
No, this right now.
What are you thinking, George?
That's not it.
Oh, this is
No.
not it.
No, you had a different chart.
Oh, I probably showed the NASDAQ composite.
Okay, then.
Is it my weekly chart with a bunch of horizontal lines?
It just looked at it could be forming a head and shoulders.
There's a head here, shoulder.
There was another chart.
Could have been.
No.
That doesn't look anywhere close.
No.
If we forget, we'll come back to it. So maybe this is a topic for next time. This is going to take me more than a month to do because I want to make sure the left strategy is always shared. But this time, Floyd is going to be the one showing the left strategy. Let me see. Where's my PowerPoint? I'm that kid with 50 tabs open and I can't even find where's my PowerPoint. Is it under documents? Sorry, technical difficulties from a young buck. Did I exit it? There it is. So we did the polls. That was today's big picture. Now we're going to move on to Floyd taking the reins back. He's going to talk about the monthly performance because I asked him if he could talk about what buy points we had because in the past month we did have a buy point. Floyd told me they bought at $46 at TQQ. Right now, I believe TQQ is about 60. I'm double checking that right now. It's about 59. Without further ado, here's Floyd Dameron.
I sent you those graphs. So
I can bring it up.
it might be easier. It's just basically, it's not, the graphs don't show what happens if you buy and sell. It compares the leveraged ETNs and the ETFs that if you held them for 12 months exactly, or just from December 31st till now, how have they been performing? And if you use the stochastic strategy, the results would be very different. So the top one, it's a little crowded, but if you look at the box in the upper left, you'll see that of the 8 or 9 I did, the best performer is the gold miners times 3. That's GDXU. It's up 85%. Nuggets, the gold miners times 2, up 79. And you go all the way down to the worst performer is SOXL. So in the last 12 months, if you own that, you're down 67%. So this gives you an idea of what's happened in the last 12 months. Go to the next one, and it's easier to read. This is for year to date, starting on December 31st. You can still see gold by far, either the GDXU or the Nugget are by far the best performers. That could change very quickly on us. But the third best performer is China Ball times 3, YINN, up 21%. Everything else is negative, but not nearly as negative as a few weeks ago. So again, this is not using any kind of buy-sell strategy. This is buy and hold. If you bought any of these on the first trading day of the year, this is how much you would be up or down. I made 3 purchases of TQQ recently, not religiously using this strategy, but letting the strategy guide me. And I use the weekly strategy. So I bought TQQ 3 different times, as low as $46.50 and as high as $50.50. Those were all purchased in April. In late April, I bought FAS, which is the financial times 3, and I bought that on $422 at $125, and it's like $120 It's about 145 or 50 now. If you're interested in that strategy, Gary Taylor's taken over the management of that strategy, and he's developed a small side business called Leveraged Edge. Some of you are members of his Leveraged Edge team, and he gives excellent videos and has suggested stochastic settings for 5 or 6 different leveraged ETFs. And you could do a trial. I think you can do a 1-month trial and get everything he has for like $50, which to me is a bargain. He's got some amazing videos that describes the whole leveraged ETF investing strategy. Then he'll give you a spreadsheet table that says if you want to trade TQQ, for example, on a weekly basis, he will give you the trading view settings so you can set it exactly the way all the back testing has shown how you'll get the absolute best results. So I'm not putting a plug in for him necessarily, but I'm 76 years old. I'm still working darn near full time as an engineer, and I'm trying to do some investing. Gary came up with an idea of getting us out to more people, and he asked if I wanted to team up with him, and I said, no, I don't. Just take my strategy and run with it. You have my permission. That's what he's done. So right now, if you're in leveraged ETFs, you're invested.
Do you know how much invested, Floyd? Do you know how much Leverage Edge is invested? Does Leverage Edge give a percentage invested like IBD?
The way the strategy is set up, you can modify this any way you want. The way we do our back testing is when you get a buy signal, you start with $10,000. When you get a buy signal, you go in 100%. You put all 10,000 in, and let's say that grows to $30,000. When you get a sell signal, you put all 30,000 in cash. And when you get the next buy signal, you put all 30,000 in. So you're 100% in or 100% out. But in reality, if someone is really trading it, they can choose if they want to leg in and maybe say 33% until they're fully invested, or 50%. So each person can decide what works best for them. But the back testing strategy we used to come up with the best buy and sell signals was either all in or all out. And then when you go back in, you reinvest all your proceeds. At some point, if you've been in this thing for several years, when you go back in, that may mean you're putting $100,000 or $200,000 in. But if you follow the strategy for many years, your money is going to grow significantly. $10,000 can easily turn into $500,000, $300,000, $100,000, $1 million, just depending on how many years you're in and how the market behaves. But when we get a serious downturn, like the COVID crisis, we got a sell signal to get out fast, and then we got a buy signal to get back in. You got back in maybe at half of the price you sold, so you bought 100% more shares with the same amount of money. And then after the COVID crisis, in about 6 months, you were up about 100, 200% because of that V-shaped rally that we had. It was just one of the most incredible opportunities in the world.
Yes, it was.
I've been buying, by the way, most people know this, I bought my first leveraged ETF about 12 or 13 years ago, and I've been trading them ever since. But when 2018 hit and things dropped pretty hard and I saw my account go down, I said, man, I got to find a better way to do this. Through a lot of blood, sweat, and tears, I finally decided maybe stochastics would help us do that. And then Rick Keller jumped in and helped do some programming for me. And then about a year or two later, Gary got involved and introduced us to TradingView. One nice thing about TradingView is we can throw in a secondary indicator like the MACD to help us make smarter trade decisions. I think I've said enough about all that.
Yep. That's the chart I was talking about.
This one
Yes.
doesn't look like it could be. I have to recollect my head and shoulders chart. I can't remember if this bar down here makes it invalid or not. But this right shoulder should be higher, which it still is, or the left shoulder is higher than the right shoulder. So I think we'll see how the market plays out.
Some of the smart people out there are predicting that we got another leg down coming too.
Yeah, because we're in the second wave right now. So maybe by that time we might go into the third wave.
Yeah, I'm in that category.
Paul Peter Jones just said that we are going to go down
So that's why if you're using the leverage ETF strategy and you have stochastic indicators, it will get you out. It'll allow you to be invested, but if we have another leg down, it will take you right out.
Yeah. So
I have a question.
what's up, George?
What do you think has happened to SOXL? It used to be so good, and now it's just been total trash.
My list is a little bit old, but SOXL says it's invested in AMD, Avgo, NVIDIA, Qualcomm, Texas Instrument, Micron, and Intel, AMAT, etc. And we all know NVIDIA has been under quite a bit of pressure. And so SOXL is down so hard and so far that if we get a turnaround in the chip companies, we could see in a fairly short period of time, SOXL could easily double. But it's been in the doghouse for a long time. If you're following the leveraged ETF strategy, you would not be invested in it. You would have been in cash a long time ago. But if it does a turn, it will get you in earlier than maybe other strategies will. But if you have a head fake, you're going to be sorry to get that back in too, because you may be selling right after you buy it. So it may take a while for the settle down, but SOXL went from a wonderful leveraged ETF to on to a total dog.
Yeah, I used to like it better than TQQQ.
Yes. Yes.
This just hurts. Looking at this, since it's like 21% up in 2010 and it's been 15 years, you've only made 20%.
Yeah, but we should not compare it that way because these ETFs have decay built into their structure.
Yep.
So we cannot say since inception because it doesn't work like that.
I do have a friend who was talking to me. I've been buying and holding TQQQ and I'm still down. I'm like, wait, you're buying and holding? So I finally checked TQQ's like highest point and he's right. He's still down from his high point. So up to each individual trader, but I think the key word is trading, not buying and hold a triple leverage strategy because the math just doesn't work out. Floyd, did you want to go ahead and start your presentation on your 0 day of expiration?
Guys, I need everybody to put their seatbelts on, please. Have some fun here.
The 0 days of expiration, they're like, you do buy same day expiration? Not a lot of people do this, and they're option traders also.
Can you see my screen?
The pros and cons of trading.
Okay, we're just going to step through it. This is actually going to be a workshop, and in some places, someone might charge you $500 to see what I'm going to be presenting to you here. So let's just step through it. This is strictly for educational purposes only. Capital loss risk is high, and it's higher with options and leveraged ETFs than maybe other securities. 0 date SPX options should be for experienced traders. So we got this guy. I call him the Joe Cool trader, that he's picking up $100 bills off the Wall Street sidewalk. But we also got Joe wannabe trader. He's picking up nickels in front of the steamrollers. Which kind of a trader do you want to be? You want to be the cool guy, or do you want to be the guy that's maybe going to get smashed?
What are you doing?
Understanding risk is critically important, and then doing something about the risk that you understand is really super important. So what are 0 date SPX options? And these are relatively new, around 3 years or so. The 0 date options are option contracts that expire the same day. So the SPX options that I was trading today, when the closing bell rang, they all expired, 100% expired, gone. And the first one I bought had a life of 6 hours and 15 minutes. And the last one that I bought had a life of about 15 minutes. So these are 0 date option contracts. Normally, you're selling them to get a credit. If you have a day like you did today, you can just let them ride till expiration, and they expire worthless. In some cases, you will find that you need to roll them to a different strike price or close them to reduce the potential for a loss. And so your maximum contract on these 0 date options, 6.5 hours. That's the absolute maximum. You can't buy them before the bell rings, and you can't own them after the closing bell rings. You can buy them and close them anytime you want during the day. You can hold them 2 minutes, 2 hours, whatever you want to do. And like today was such a perfect day. Every contract that I bought, let it ride to the closing bell, and all of my contracts expired worthless today. I grew my account. I got a pretty good sized trading account, and I grew it 1% today just by trading these options. Significant profits are possible. You really have to have proper position setup and proper system management. Even when you do that, you can have significant losses.
Wait.
So the zero DT option trading volume has just exploded. The SPX is probably the most popular index in the whole world. On the options on the SPX, about 50% of all SPX option trades are these zero date options. When you hear that, you know something is going on, and the smart money is involved. I imagine there's computer trading going on. I know that Tom Sosnoff with Tasty Trade is into it very heavy. I've watched about 8 or 9 videos that Tom has produced on these zero date options. So there's a lot of people involved, but it is a high risk situation. Here are the strategies people are using. I was surprised how low the number is. There's only 11% of the trades are condors or butterflies, 13% call spreads, 17% put spreads. Some people are just doing outright calls and puts, and those could be naked or otherwise. My favorite trades are iron condors, which I'm going to explain to you what those are if you don't know. In the iron condor, the left half of it is a bull put, so you can do a bull put all by itself, or you can do the right side of an iron condor and do a bear call all by itself. This is what an iron condor is. To put it on, you will have 4 option positions in play simultaneously. The left half is a bull put spreads. In this particular case, your long put is a $15 put, and your short put is a $25 put. You could do that all by itself, or you can also add the bear call, which then completes your iron condor. In this particular case, you're selling a 45 strike call and you're buying a $55 call. Here's an example of an iron condor. You could buy the long put, which is $15. You can sell the $25. On your right-hand side, you can sell a $45 call and buy the $55 call. The primary goal is you want the underlying security, SPX, to stay between 25 and 45 for the duration that you own this. And so if the midpoint is right around $35, when you sell this, you're hoping it doesn't drop more than $10, or you're hoping it doesn't go up in value more than $10. So that's how you play the iron condor. Here's an iron condor I did today. And today was like the perfect day. This is a 15-minute chart from Marcus Smith. Now, Marcus Surge. So this right here, these 15-minute bars, this represents today. In about 15 minutes after the market opened, I sold the 530 put, and I bought the 500 for 550 for protection. So I had a 30-point spread and an extremely low delta of 0.03. At the same time, simultaneously, I sold the 570 call and I bought the 5800 for protection. So my gap between the two shorts is 240 points, and that's about a 4%. So that's pretty sweet. And if the SPX was around 5650, it would have to go up 2% in one day or go down 2% in one day before I would lose a single penny here. And so I got 75 cents, which doesn't sound like very much money, but remember, I only owned this thing for a little over 6 hours with 20 contracts. The net gain to me was $1,500 minus some fees and a commission. Maybe I made $1,400 or so, but I made that in about 6 hours. This just gives you a real world snapshot of what I did today. And I did 5 or 6 of these today, and it ended up being a pretty spectacular day. But notice we never got higher than 57.20. And so my short call was $50 higher than that. And we never got lower than about 56.30. And I'm here at 55.30, like 100 down. And because I use these very low deltas, and if you listen to videos, out there. Almost everyone is going with much higher deltas than I use. And that's fine. You can do whatever you want. If I used a much higher delta, this 5720 might have gotten me in trouble, or this number right here might have gotten me in trouble. So I like to go way out. I'm what I call a chicken trader. That's going to be up to you as an individual trader, how aggressive you want to be. I prefer not to do a lot of adjustments, and I don't mind making small profits every day. So let's just go on. What are the pros of owning zero-date S&PX options? It's very quick action, and you have no after-hours risk. When that closing bell rings, and maybe there's a minor adjustment for about 10 or 15 seconds, but when the closing bell rings, let's say 30 minutes later, there's a major announcement and the market tanks. You have no risk of that happening to you. All of your options expired when the bell rang. Or if there's a major positive announcement and the market spikes up, you have no risk. If I go back to this chart, notice each one of these is a day. Look at this giant gap down. But I can't own it until that price bar right there when the bell rings. And so if I got in right there, notice there was almost no downside risk here for these are 2 days here, and almost no upside risk. And so if you have a wide body with a wing iron Condor, there's a high probability you'd make money, okay? The next one, accelerated time decay, because this thing only has a 1-day life and everything is driven by theta here. If there's a 75-cent premium, that 75 cents has to go to zero if this thing is going to expire worthless. Sometimes it looks like the time decay may not occur in the first hour or two, and then all of a sudden it really starts moving forward. These are high volume trades, and the bid-ask spread is very minimal. You can get in. There's no problem getting in. There's no problem getting out. These are very liquid options. This is a really big one. Cash settlement only. It's impossible for you to be assigned the S&P option shares because of the European cash settlement. The only thing it can do is you can be handed money or you have to hand them money. No shares, trade hands, no chance of assignment. That's a big deal. If you trade SPY, there's a lot of disadvantages to trading SPY compared to the SPX. And one of those disadvantages is if there's a big announcement after the market closes, your SPY options could be severely impacted, whereas your XPX options will not be impacted. This number 4, this cash settlement, is really important. I know that I can never be assigned those shares. They're European style contracts. The settlement occurs at the end, and if one leg of your option is in the money, there'll just be some cash deducted from your account. Only cash is involved. In taxable accounts, you can use margin to increase the number of contracts. Now, here's an interesting point. I'm using E-Trade, so I called E-Trade up and I said, hey, I just picked the number, a theoretical number. Let's say during the day I'm $1 million on margin, and then all my options expire at the bell. I said, how much margin interest are you going to charge me? And they said, $0. We only charge you margin interest for margin you carry overnight. So I can go on margin all day, every day, and incur no margin interest expense. I found that interesting. There's at least 100 different option combinations you can come up with every single day on the SPX. You give all of us $500,000 and say, go trade the SPX, and all of us would pick different combinations and have different results. As long as the trader has buying power, you can have multiple positions open at the same time. You just want to be sure you're paying attention to risk management. If something happens, if there's an intraday event, and I don't want to predict anything, but let's use a theoretical. What happens if Iran drops a nuclear bomb on Israel when the market is open? Everything's going to gap down. They're probably going to shut the market down. But in the process of all that happening, if you have a whole lot of these SPX options in place, unless you have controls in place, it could be pretty painful. It does not take a large account to trade SPX options. 25,000 is suggested. 500,000 is better. I really think you ought to have probably even more than that to really trade these successfully.
Floyd, you meant 50,000? You said 500,000.
50,000, 500,000 is even better. But I'd say 25 minimum. I really think you probably should have at least 50 in play. And and you could do it in an IRA, you can do it in a Roth IRA, you can do it in a taxable account. If you do it in the IRAs, then obviously you can't go on margin. And maybe I'm the only guy that does this. I love the ultra low delta options. And by ultra low, a delta is below 5%, whereas people like Tom Sosnoff might be doing 15 or 20 level deltas. And I don't want to play that game because like I told you earlier, I'm a chicken trader. And in the last 150 trades that I've traded, 90% of my trades were profitable and 70% of my trades went to the closing bell and expired worthless. But you have to do proactive account management. These are not instruments where you buy something and then you want to go shopping for 3 hours. No, you can't do that. You don't have to look at it continuously, but you probably ought to look at your screen a minimum of once every 15 minutes, if not more frequently. Now look at number 11. I love number 11. If you have a taxable account, even though maybe you only held the option for 30 minutes, let's say you make $1,000 in 30 minutes, 60% of your gain is taxed as long-term capital gains, which for most of us, that's 15%. Whereas if you made the same profit on SPY, your tax rate would probably be 30% or maybe higher. So this idea that, I don't even know why this is set up, but I love it. On a large account, this could save you $10,000 in federal taxes every year. So what are the cons? For one thing, you need to be a level 3 option, and other brokerages may call it something else, but you have to have privileges to do spread trades. So if you've never traded options before, they're not going to give you level 3 approval. You have to have options experience. If you don't have any experience at all, they'll let you do covered calls, which is a level 1. You do a few covered calls, and then you come back in a month or two and say, hey, I want to help higher level. So there's an application process and an approval process. If you trade 4 or more 0-date spread options within 5 business days, and you don't let them go to expiration, let's say you close them out early, you want to take profit early, or you close them because you're trying to minimize a loss. If you do 4 or more than 5 business days, you'll be designated as a pattern day trader. Oh, I don't care. Who cares? But as a pattern day trader, I think your account has to be a minimum of $25,000. If your options expire worthless, that doesn't count as a day trade. Now, if you had a count of 25,000, let's say you lost $1,000 that day, they won't let you do any more trades until you get your account back up to 25,000. Just be aware of your broker requirements. If a trader does not set up automatic closing orders, and there's lots of ways to do that, but you got to be very careful how you do that. But if you don't want to have automatic closing orders, then you must closely monitor your position and then do manual closing orders. This is not a buy and forget strategy. Risk is significant. Anytime you have one of these on, you have risk.
This is Rick. I agree. If you could maybe at some point show those max losses on those trades, there is significant.
Yeah, I got a slide coming. So assume you'll have losing trades. And that's true if you buy individual stocks, if you buy anything, you're not losing trades, but don't let it stress you out. I've had a few losing trades and I could have thrown the towel in. I said, no, I'm on this horse and let's keep going here. But losses can occur quickly if the S&P makes a big move. Now, remember what I told you, though. Let's say the market has a major gap down. You can't trade the S&P options until the bell rings anyways. You didn't own it overnight, so you don't have a gap down exposure. You can only own this thing between the 2 bells. But trading commissions and fees can add up very quickly, maybe as much as $1 or maybe even more per contract. If you open the position and don't let it expire worthless, then you're going to pay $2. I called up my broker and I said, what the heck's going on? He told me my commissions for option trades were only 35 cents a contract. why are you charging me the equivalent of about 90 cents? And I said, there's a regulatory option fee of 55 cents that we throw on, which I didn't know about. So I called the Chicago Board of Exchange. And I said, hey, E-Trade's charging me 55 cents. Are you guys making them do that? And they said, we can't tell you anything about E-Trade, but my impression from what the guy told me, and he sent me a table, I think E-Trade is getting charged 35 cents and they're choosing to charge me 55 cents. And so I'm negotiating with them right now, see if we can't take care of that.
Yeah, that goes for all options.
No, but the SPX is the highest. The guy told me that if you trade the Russell index, instead of 55 cents, it was only 7 cents. So of all of the indexes, the SPX has the highest, but it also has the highest volume. So I think maybe we should own stock in CBOE, because I think CBOE is working on a money machine here. Millions and millions of these options are being traded, and they get 35 cents or more, and they have zero risk as near as I can tell.
Yep.
But anyway, position size is very important. And I would suggest that on any one of these trades, you limit your risk. In a very small account, you might have to risk 3 or 4%. In a very large account, you may not want to risk more than 1% for any one trade. But I go for the very high probability trades. I will only consider trading if my short strikes have a delta below 5. That's just me. That's the way I like to trade. You have no overnight risk whatsoever. You have no assigned risk whatsoever. You can use stop limit orders if you want to limit your losses. And if you think the market's going to be bullish and you don't want to do a 4-position iron condor, you can just put a bull put spread on, which only has 2 options in play, which cuts down on your commission and fees. If you expect bearish action, you can just do a bear call. If you think minimal price changes like we had today, then you can do an iron condor, which is just the bull put and the bear call traded simultaneously. Or you can do a butterfly spread. Check all order and ticket instructions before executing any trade, because if you're going to do an iron condor, you have to tell them, is this a limit order? Is this a market order? Then you have to give them what are the dates, what are the strikes. I strongly recommend you take an extra 3 seconds and look at every single element of your order ticket before you hit execute, because once you hit execute, if you had a mistake, you may have to live with the mistake. I made a mistake the other day and I was thankful. All of a sudden I saw my order was rejected and I go, how dare you reject my order? And then I looked there and I go, oh, I did something wrong. And I was lucky that they rejected my order. I've been thinking a lot about risk management, and rather than doing credit spreads, is there an advantage to doing a bear put debit spread? I've done 4 or 5 of these. You have to put up quite a bit of cash to do one. I did a bear put debit spread a couple of days ago, and my wing was 20 points. The maximum value they could have is 20. And so I was able to buy this bear put spread for 19 and expired worthless. And so I paid $19,000 and they gave me $20,000 in return. So I made $1,000 profit. So I've been thinking a lot about bear put spreads, debit spreads. And I've got at the end, I have a couple of bonus slides I'll show you on how to set up a bear put debit spread. 11 is critical. You must control emotional trades, revenge trades. If you find that your heart rate's up and you're animated and trying to thrash at the keyboard, my advice is close every position and stop trading. Get that all under control. At the end of the day, do a full assessment of your trades, document lessons learned. What did you do right? What did you do wrong? What could you do better? Did the market throw something out you didn't expect? Plan to improve almost every day. If not every day, at least every week. Assess. Did you do the right setups? Did you take on more risk than you intended to? Did the trade work like you intended to? Make sure all trades are accurately recorded in a trade journal, a spreadsheet, whatever. If you've got 3 or 4 of these iron condors open simultaneously, you absolutely have to know what are the strikes on your options. You want zero confusion about this, because if the market makes a turn and you need to adjust one or more of your positions, you absolutely have to know exactly what your positions are. Be hyper aware, an event could cause rapid position gains or losses. One of the events I don't like, it seems like every time Chairman Powell speaks, the market doesn't like it. With a little bit of an exception. He spoke yesterday, I think it was, but a couple of weeks ago he spoke, and the market started dropping like a rock. There could be employment reports, housing reports. There could be some announcement out of Washington, D.C. There could be something from overseas. So be hyper aware that you have no control over these things. If you see your option position going from highly profitable to just barely profitable or negative, take action. Your options can be hypersensitive to SPX price changes, especially in the first couple of hours. We see very wide option price swings, and sometimes that's really good. If the swing is away from your position, you're loving it. But if the swing is putting your position under pressure, you're not liking it at all. Your position can go negative very quickly. Assess the situation, be prepared to act. And if you have an automatic stop limit in play, then it may take you out automatically. But be very careful how you set that up, because you may get out much faster than you had intended to. And there's one of the Greeks called gamma. Gamma is a measure of the rate of change of delta. There could be gamma effects on these zero-date options, and risk increase on your short strikes. If you have a delta less than 10, I like it less than 5, you have lower risk, but this doesn't say no risk. If you choose to take a little more risk and have deltas more than 15 or 25, you have mid-level risk. And if you have the guts to trade delta higher than 35, you have very high risk. There's probably a good chance. I know you're going to gain more premium, but you're probably going to have to close your positions early and accept more losing trades. It's up to each person's personality on how they want to trade. I've noticed that very low deltas on these zero-date options behave as if they were at least 3 times higher. So if you have a delta of 0.03, assume it's going to behave as if it had a delta of about 10. That's just the nature of the beast. Okay, this is a graph no one has seen because I developed it in the last couple of days. And the reason no one's probably ever seen a graph like this is what I did is I took, for 25 years, I have almost 7,000 data points here. I said, what is the percent change after the open? Not from yesterday's closing price, from at the opening price, what is the percent change? And 95% of the time, you will be up less than 2%. And 99.6% of the time, you'll be up less than 4.6%.
It's the percentage change from the open to the close, right?
No, this is not open to the close. This is the open to the intraday high.
Oh, gotcha.
Not the close. I want to know if this thing goes way up, say 2 or 3 hours after the bell, do I have to close my position at a loss maybe? And so what is the risk that sometime during those 6.5 hours, this guy could hit a high and it may be much higher than the close? So this graph shows you on the high side, this graph shows you on the low side, and they're very similar, but not exactly the same. From the opening to the lowest point of the day, 95% of the time, you're only down about 2% or less, 2.3 or less. And 99.6% of the time, you're down less 5% or less. So today's iron condor that I showed you earlier, the body was 4% wide. So on the call side, SPX would have had to have gone up 2% before my short strike went in the money, or it would have had to have dropped 2% today for my short put to go in the money. You can see that on about 95% of all days in the last 25 years, it wouldn't have happened. If I took out 2018, this graph would look very different, but I left all the days, almost 7,000 days. If you look at the iron condor that I traded today, you can see that 2% was all the way up to this line. The very high of the day was no higher than 57.20. And my short call was 50 points higher, not even close. And on the downside, the lowest point was about 100 points higher than my short put. So this trade right here that I shared with you was the ideal trade, and 20 contracts made about $1,700–1,800. But let's talk about risk. This is a very important table, and this sort of looks like a frostbite table that we use up here in Alaska when you look at what the temperature is and what the wind speed is, and are you going to get frostbite or not. So what I did is on your bull put side, what are the widths on your wings? And on the bear call side, what is your width? So let's say you have a width of 30 and you have 20 contracts. How much are you at risk? If you had a massive gap down and you didn't have a way to get out, you're risking up to $60,000 times 2,000. Those 20 contracts represent 2,000 shares. So 30 times 2,000 is $60,000. Notice I put dark green, light green, yellow, and this, I intended this to be red, but it came out purple. I'd recommend you never trade in the yellow or purple range, and be very careful if you're up here in the light green range. Just be aware of what kind of risk that you're taking under the absolute worst case scenario. I would say 98% of the time, if SPX starts going against you, you should be able to get out with a loss of maybe no more than $10,000 or $15,000. If you didn't pay attention or were incapacitated, you could lose up to $60,000 on just a 20 contract trade. Okay, maybe you want to reduce your wings to maybe a 20 wide wing, and with 20 contracts, your risk is $40,000.
Quick question. You mentioned that you need to watch the trade every 15 minutes. Since you already have stop loss of 1 to 3% or whatever that percentage is, why is it that you're not using, I'm assuming you're using Think Custom platform, or even E-Trade offers that you can do one order cancels other. So that way, whatever your gain is, you can just take that gain and get out, or whatever is the loss is, take that loss and get out, and you don't have to watch the market. Is there any reason why you're not doing that?
I'm very disappointed. I'm using E-Trade, and I've asked them 3 different times. E-Trade, I cannot do a closing order on a spread. Why they won't let me do that, I don't know. Fidelity will let me do it. Schwab will let me do it. Tasty Trade will let me do it. Why aren't you guys letting me do that? I may change brokers fairly soon. We had some recent experience with stop limit orders where trades were taken out. It's hard to say if there's actual manipulation going on or not, but we've seen stop limit orders get hit. And 2 minutes later, SPX is back down to where you think it would be, and you're just wondering, did someone drive the price on SPX up or down just to grab somebody's money? You have to experiment with this, and you may have to put a stop limit order in at a higher level than what you'd plan to avoid manipulation. I've got a slide coming up on how to put automatic protections in, so let's keep going here. Actually, your question or your comment was perfect. Is there a trade management strategy that reduces trading risk? Important question. What is that strategy? The best way is to set stop loss on credit spread options, okay? So the lady is saying, just stop it. So the recommended maximum risk, if you have a $50,000 account, we're suggesting maybe you not risk more than $1,500, which limits how much you can do with these options. But even if you have $1 million account, you don't want to risk more than an amount shown here. So how do you do this? You can do a limit closing order. I do limit closing orders all the time to capture profits. And if I'm a little bit nervous about market action, let's say my 75-cent contract is showing on the closing table that it's only worth 15 cents. And I may say, I don't want to hold this thing another hour until closing. I'd rather capture 60 cents of profit. So I can put in a limit closing order on my iron Condor, close it out, and I can put a 15-cent price in there. Normally, if it's showing 15 cents, it won't close right away because the market maker has to make some money. I could close out right away if I put in 20 cents, but I'll put in 15 cents, and if the market is behaving normally, it'll probably execute in the next 10 or 15 minutes. So that's one way to close a position you already have. For example, if you have a bull put spread and you earn $1, as soon as you execute that contract, you could put an order, a limit order in and say, if this thing ever gets down to 25 cents, so you can do that on your trades. You can do a stop limit order. And on a stop limit order, the order isn't executed until the stop price is reached. So you can set a stop price. Let's say I earned $1 and I want to minimize my losses so that I sell at no higher than $2. Once the $2 level is hit, then the order is executed. If the option prices are changing rapidly, you may not get that $2. Some people do a stop limit order and put a higher price in as a market order, so to make sure that if things are moving very fast, you can get out. And then there's one cancels the other order. That's pretty cool. A lot of people use one cancels the other, and it looks like this. You put in two sets of instructions, one to take a profit and one to minimize your loss. And whichever one is achieved first executes order number 2, or if order number 2 executes first, it cancels order number 1. So that's something you can do some looking at to see if that would be a way to help control. And like Yoga said, if you set these up properly and not too tight, if you set it up too tight, you probably have your order executed when you don't want it executed. But if you set some reasonable limits, you can do much less monitoring. So I watched a video by a guy from Sweden, I think Sweden, maybe Finland. He had a pretty good video. And he said, I always set a stop loss. And he was talking about 0-day SPX iron con. But I totally disagree with how he set up his stop limit order. He set it at the premium plus 5 cents. And then he went further out on 20 cents. But if you say that you want to be stopped out at your premium plus 5 cents, you're going to have a whole lot of orders that are going to be closed out at a small loss. I like the idea of setting stops, but I would never do premium plus 5 cents. I might do premium times 2. If my premium is $1,000 and I don't want to lose more than $2,000, say, each individual person has to determine what works best for them. So here's how you set up on the E-Trade platform. Here's how you set up an iron condor.
Floyd, before you go, I believe John online was referring to placing each side at what he received for the whole iron condor. If he gets like $1 for the condor, I think he might be stopping the put side at $1 plus 5 cents.
Yes, I think that's true. Because you can only get stopped out on one side. The SPX is either going to go up or going to go down. One or the other is going to execute.
So that's about double what he got. The call side, he got 50 cents. Put side, he got 50 cents. Then if he's stopping, it is like a 2x stop, right?
I believe the way this fellow John was setting this up is he closed out the entire iron condor so that he didn't have any risk. Because occasionally what will happen, it's pretty rare, but I'd say on a few percentage of the days, the market will go down and take out, say, your
a double stop.
and then all of a sudden it skyrockets up, and then you lose money on the other side. There's a rare case where you could lose twice as much money, even though you thought you were protecting yourself.
Yep, that happens. And Tammy Chambliss talks about that a lot.
But why would that happen? If you're putting it as an iron condor, all 4 legs will be executed based on your stop limits, right?
But that could happen if you set it up so that only the side under pressure.
Oh, okay. So you're setting up 2 separate trades in that.
You see the first line, stop losses set separately on each side.
So
You have the ability to do it either way,
it's
on
probably
each side or the whole thing.
you're going to make less profit. What I suggest next, but it's probably smartest to just close the whole iron condor down and be done with it. Plus,
Let me say this, Floyd. This is Kevin. What happens is that while one side of the trade is losing, the other side is making money. And that's the Hobson's choice. Just how far does it go before you decide to take the profit?
well,
and-
how many hours left until the market closes? If the market only has 30 minutes to close, you're probably safe. If you have 4 hours before the market closes, maybe you're not so safe.
As you well recognized earlier, the gamma is decaying very fast in that last hour or so
Yes.
That gamma is working against you.
Yes.
So you have to keep that in mind. In fact, when I talked to Sosnoffs about this last year, he was of the opinion, and I haven't checked since then, don't go past 2 p.m. Central, which is 3 p.m. Eastern in one of these zero TEs
Well,
because of the gamma. What's your thought on that?
I'm not an expert at this, but the other thing preaches religiously. I've listened to 10 of his videos. He recommends that you always close out when you've made 25% of maximum profit. So if your premium is $1, give 75 cents of it back to the market and only take 25 cents home. I don't do that, but Tom Sosnoff made $700 million or whatever when he sold Thinkorswim.
Biased
No,
towards
but-
many trades because he collects fees.
Reason he is probably saying that is because he's also doing high risk, high delta trades. You're doing 0.03 versus he might be doing 0.15.
So there's 30 different ways to trade these babies. I want everyone to understand. I've done like 150 trades. 90% of them made money. 70% of them expired worthless. Each person has to understand their own personality, their risk tolerance, and their trading styles. I hope no one goes away from tonight's presentation and says, the only way I can do this is the way Floyd does it, because I don't know your personality. I don't know your financial situation. I don't know your risk tolerance, etc. So I'm shining the light on something that most of you probably never even heard of before, but I'm shining the light to expose you to a different element of the market as a way of sharing with people.
Floyd, let me ask you this. When you enter, are you looking at an opening range breakout at the close 15-minute? Because that's what I understood you to say. And then you would leg into your iron condor.
What I do is when the bell rings, I write down the price of SPX and I wait about 2 minutes and I look at the price of SPX. I write that down. I wait about 5 minutes. I write down the price and I'm looking to see, is there an obvious trend going on? Is it going sideways? Is there a bias up? Is there a bias down? If I see a strong trend, then I'm going to wait and not do anything. If it looks like a sideways or a minor up or minor down trend, usually after about a minimum of 15 minutes, a maximum of 20 minutes, I will execute my first iron condor. So I set up my trade ticket, which is already set up ahead of time. I make adjustments to the trade ticket because I want to be sure that my shorts have deltas around 0.03. And I decide, do I want a 20 wide wing? Do I want a 25 wide wing? And then I look at, okay, I got it set up. And I notice that they only want to pay me 60 cents. I'm not going to make a trade that has a 6.5 hour life for 60 cents. And so I cancel. I haven't placed the order. I wipe the ticket out and I say, okay, let's reassess. And I'd like to make at least 75 cents. I would prefer to make about $1.25 on the trade, but I don't sabotage myself because to get $1.25, maybe I have to let my deltas go up to 10. And that's a violation of my rule. I'm not going to go to a delta 10. I might go to a delta of 0.05, but I really even don't like to do that. And so I have to play a little bit of a game with my order ticket. I got it in front of me. I put the strike prices in. I look at what the bid and ask and what the midpoint is. And then if I'm comfortable, and I look at the price of SPX, is it still where it was 2 or 3 minutes ago? Yes or no? If I'm happy with all that, let's say I can get 75 cents. Boom, I hit execute. And if the midpoint was 75 cents, I guarantee you it will not execute when I submit it. It will only execute if the midpoint goes up to 80 cents, say, and it might not even execute then. And so if it stays around 75 cents for about 2, 3, 4 minutes, and it's obvious that it's not going to execute at 75 cents, I may go in and drop my premium limit number to 70 cents, hoping that will execute at 70 cents. So that describes the mechanics of how I do the first trade in the morning. Does that help?
Absolutely. And I just want to commend you for coming out with this. I've played this with zero DTE a while back, but I was playing with a lot higher deltas. Listening to you talk about this is very enlightening, and I do appreciate it very much.
Thank you. I appreciate that. And so when you use the higher deltas, were you having to make adjustments or get stopped out pretty frequently then?
you got to have a high sphincter factor. And the old saying, I'd rather be on the ground wishing I was in the air. Like you point out, there are a lot of different ways to do this, and it's evolving. I have not tried going to a really low delta because I couldn't find that it was cost efficient given my costs of each trade, but I may look at that. One thing I didn't realize is with Thinkorswim, you can actually exit one of these based on the chart rather than a delta. So my risk has always been the effective gamma going late into the trade, and it's going against me, and calculating the extrinsic value of what that loss is going to be. I know the intrinsic, but the extrinsic is what's always got a hold of me. Now that I've got a better understanding of how to handle that, maybe I'll give that another try.
Let me show you something that I've had fun doing. If you go 10 minutes before the final bell, which would be this mark right, oh, this is a 15-minute, be that right there, be this price bar, it'd be that price bar, I think that one, that multiple times I have gone to like the 12-minute mark, 13-minute, 10-minute mark, and I look for a delta of about 3, 4, 5, and I'm probably going to do it on the call side because typically near the end of the day, not every day, but here lately, the market sells off at the end of the day. The market sells off. Here it didn't melt it up, but usually I'll do a call with a delta of 03. I'm about $30 or $40 away. It amazes me at times I've earned like 50 cents for 12 minutes of risk.
Well, that's good.
It's just, wow.
That's good. Yeah.
You have to be careful. And if it starts going against you, you got to have your closing order ready to go and hit the execute button like right now. But it's amazing to me that I've made $1,200 and $1,400 profit with about 9 minutes of risk.
Okay, Floyd, have you ever used a VWAP? I'm sure some of the listeners here on this audio are familiar with VWAP. To me, that's always been one of those that I've wondered what the impact would be. You don't have the ability to sit there all day long, but after about the first 35 to 45 minutes when VWAP first starts, I was wondering if you've done that. What's your experience been?
I haven't done that, but I noticed, did Steve sign in? And maybe Steve could chime in. Steve Sweat, I think I saw he was on earlier. He's still on? Steve, you with us? He might have signed off. I've heard of VWAP. I know what it is. I've never used it personally, and I need to do some more learning.
But
I tell you though, 90% of my trades have been profitable and 70% have expired. But I've got something that's working for me on an average day. My account is growing between 0.5 and 1.4% per day. I make sure that if I have a really bad day, my account doesn't go down more than 2%. I've only had 2% loss, 1% losses, and multiple days where my account went up 1.2, 1.3% each day. These low delta options, at least for me and my style of trading, I think they're working. So let's just go on here now. Let's see what my next slide is. We covered the one canceled all. We covered this one. This is the setup, and your ticket will probably look very different, but on each trade, this is an example of the bull put. Okay. Notice that on the put side here, notice here's a delta on the short side of 0.034. I love it. So I do a 52.95, 53.25. That's a 30 wide spread. On the call side, I always make the spreads the same. If it's 30 on the put, it's 30 on the call side. You can do uneven ones, but I don't do that. Here's the bear call side. And notice that I have a short delta of 0.31, which is right there. So here is showing the midpoint is $1. Bid is 70 cents. Ask is $1.30. I would place this order at $1, but doesn't execute. I might drop it down to 95 cents. I don't think I will ever drop my price more than 2 times. If I can't get an execute, let's say I drop this down to 95 and it doesn't execute. I drop it down to 90 cents and it doesn't execute. I probably will cancel the order and start over again. There may be an exception where I reluctantly went down to 85 cents, but I just don't want to get in the game of chasing this stuff. There's too many other options out there. And never, ever do one of these if you're only going to make 20 cents or something. It's way too much risk and no reward. And notice for the last 20 days, I did this about a week ago, for the last 20 days, the ATR 148. And notice here, my short is 53.25, 56.60. Look at the spread. Try to get the spread greater than this average true range on the SPX. Update this occasionally because it may be a different number now. Here I said the approximate probability of making maximum profit. If you take the deltas, it's 93.6% of making maximum profit. But remember my earlier slide said at these very low deltas, assume that it behaves as if it was 3 times higher. And if that's true, your probability of making maximum profit is not 93.6, it's only 81%. But if I went to Las Vegas and I had an 81% chance, I think I could make some money. So here's what an order ticket looks like for an iron condor. Notice I have to pick the expiration date, April 28, on this particular day. I'm going to buy a put, I'm going to sell a put, I'm going to sell a call, I'm going to buy a call. In this particular case, if I got it executed at that $1 price, my net proceeds is $14.45 on 15 contracts. And what's the impact on purchasing power? For this particular trade, my purchasing power is reduced $43,544 for those 15 contracts. I have a 30 wide spread. I'm doing 15 contracts. So that totals $45,000, but I'm getting paid $14.45. So my net deduction on buying power is $43,554. If you had a $25,000 account, you're not going to do this trade.
Floyd, yeah, the 43,554, that's your maximum loss. So that's where the buying power.
That's the maximum. Yep. Maximum loss. If SPX moves so much that it went all the way to your long put or your long call.
That's why your broker won't let you put on that trade if the account would drop below zero.
If you don't have enough buying power to take maximum loss, they won't let you do the trade. If it's a taxable account, they will let you go on margin though. So notice that your risk of $43.55 and the reward. So the maximum return for the trade based on the risk amount is 3.3%. You would never want this number to be lower than 2, and in some cases, maybe it's up as high as 4 or 5, but you wouldn't want your return for the rest to be down to 2%. Always review your ticket. Notice I've got lots of things here. Notice I have to say I want a net credit. I'm not doing a market order. This is a limit order when I say I want a net credit. If I put a market order, I might only get 70 cents for this baby. This is the ticket. I want you to make sure on whatever platform you're using that you don't hit place trade before you have confirmed this is exactly what you want to do. Okay. So what is my experience? I prepared this slide a week or two ago. I'm up to 150 contracts or 150 trades. At the time I wrote it, I had 120 trades that I did during the month of April. 91% were winners. There was a few where maybe I broke even or lost $200 or $300 or maybe lost $800 or $900. There's a couple where I lost a few thousand. I don't expect my 91% win rate to be sustainable. I think maybe that's an anomaly for April. If I expect 91%, I'm probably headed for disappointment. But I think my win rate using these low deltas should be 70% or higher. 70% of my options expired worthless. That is what I call success. No matter the time of day, profitable trades can be executed, even up to the last few minutes. I conclude that zero-date options is another strategy in my toolbox that I can actively use to complement my leveraged ETF strategy, my individual stock trading strategy. I don't want to do any one of these strategies all by itself in a vacuum. I want to have a little bit of a balance on what I'm doing. This strategy works for me because I'm working from home. I couldn't do this strategy if I was in a big office. People all around, the phone ringing, and people coming in wanting to talk to me. And it really helps that up here in Alaska, the market opens at 5:30 a.m. And I don't usually start my engineering work until 8 a.m. And so I have a couple of hours here of interrupted time where I can really hone in on what I want to do in the market. The market up here closes at noon. I can have meetings in the afternoon, work on projects or whatever. It means I have to get up early. I'm up at 4:30 every morning, which is a little early. I make breakfast, get coffee going, figure out what's going on with the market so that when the bell rings, I'm ready to go. And it does take a certain amount of energy to proactively trade these kind of options. You need to have exercise, eat healthy, take breaks, get good sleep. And if any of these things are out of balance, you probably shouldn't be trading these options. Here's a big one. I traded my first stock 62 years ago when I was in the 8th grade at about age 11 or 12. I've been trading a long time, investing in my company's 401k since 1986. I do not need these profits to maintain my current lifestyle. I have no urgency that I have to make money doing these trades, and that takes a lot of pressure off of me. And I would say that if you're going to trade these, don't use money that you have to live. Now, I wanted to talk just briefly about the bear put spread, which is a debit spread. The iron condor is a credit spread, a bull put spread, a bear call spread. Those are credit spreads. So a bear put spread, I grabbed this on a website for someone called Option Trading IQ. A bear put spread is one of the easiest option trades and a great place for beginners to start learning their journey. And if you pay, let's say you pay $2,000 to put on a bear put spread, you know that is the absolute most money you could ever lose. You can't lose more than what you pay to put one of these spreads on. A bear put is an option strategy used when an investor expects a moderate drop in price. Uses two options. So let's look at these two options. So here you sell the lower price strike on a bear put, and you always buy a higher price strike. That's your protection. And so if you made $130, your maximum profit in this example is $370. That's pretty rare that if you paid $130, you'd make $370. The way I've been trading these, I may pay $19,000 and hope to make $1,000 profit. With the low delta options, you would never have a situation like this, but I just pulled this off of a website. So let's go back to here. I'm almost afraid to ask. Does anyone have questions?
Yeah, you mentioned a great presentation. You mentioned today you did it 5 or 6 times. So did you recycle the same $60,000?
No, I was watching the market very carefully, and I was taking a risk. By the time the bell rang, I had 5 iron condors, which means I had 20 option legs. When the bell rang, they all expired worthless.
20 combined total.
I had 20 different puts and calls.
You had 5 iron condors, each with different strikes.
I had 5 iron condors on the call side. The strike prices were identical. I had a 5770, 5800 bear call. So on all the iron condors, the bear call was identically the same. The difference was on the put side.
So every hour you would add like 5 more.
I did 3 in the first 2 hours, none in the middle. I did one about 4 hours in, and the last one about 5 hours in.
Okay, so you don't put profit take orders to close them out. The goal is to let them expire.
That is the goal, but I'm smart enough to know that if we had a day very different from today, I may have been, let's say the market was headed down, I probably would have been closing the puts. I might have rolled the puts down. When you roll the puts down, you want to make sure and look at the ticket. You want to keep it on the same day. You don't want to roll down until tomorrow.
Yep.
So if the market is moving slowly down, I may roll the put side down $5 or $10, and that might cost me, say, 30 cents but I may do that because that may be a smarter move than closing the whole position out. It's a dynamic situation, and I can't tell you exactly what I would do depending on the situation, but I've rolled puts down, I've closed the put side only, or I've canceled the whole iron condor. I'm just sharing with you how I trade.
Yeah, it's thank you.
And it's rare. It's a rare day that I would have 5 iron condors all live at the same time. I'm more comfortable if I only have 3 at the same time. I have a very large account. If you have a small account, there's no way you could have 5 of these babies going at the same time. And I was probably a very large number on margin today too. I really hope this was helpful. And I hope everyone understands not only is this potentially high reward, this is potentially very high risk. I don't want anyone to think that you're automatically going to be Joe Cool on the left here on this slide. You might be the guy getting ready to be rolled up by the steamroller here.
A couple of
When you
things
look
I
at
want to
rolling-
point out because I trade these daily and have been for years. If you're closing the whole spread, the long and the short, sometimes the long will be in the zero bid and 5-cent ask.
If I see 0 bid, then I probably won't close that side out.
So that can block closing out the whole spread. If one leg is stuck because of no bid, that can block the whole thing.
And that tends to happen later in the day. Earlier in the day, you don't find very many of them that have 0 bid, but as you get closer to the bell,
Yeah, that happens a lot.
yeah, so you hope when those babies go to 0, you're in a good spot and you're making money.
I'm just saying in an emergency you're trying to close and you're saying, why is it not closing? I'm adjusting my price. That's why. So close only the short.
Or in an emergency, you just put a market order in and take whatever price you can get.
Even a market order will not close if one leg is stuck.
And that's why I'll just close that one leg that's in danger.
Yeah,
Yeah, close the short.
It's right. Just close the short. In an extreme example, you might be glad you left the long open.
When the market suddenly moves, I will go and close those shorts and then put them back on. And like you said, you're glad you left the long because it will gain some value
Yeah,
in the meantime.
thank you for that comment.
If you wanted me to share about what can happen if things go wrong, I'm happy to do that.
Absolutely, Rick. You share as much as you want to share here. Rick's going to give everybody a little bit of a reality dose. Rick is the guy that helped me about 2 or 3 years ago. Rick called me up and said, I'm a programmer. Quit doing all your back testing by hand. Let me help you out. This guy did a miracle for me. He set up an Excel spreadsheet. What did that one spreadsheet have? Did it have 200,000 equations, Rick?
Like 210,000 equations.
210,000 equations I was trying to do by hand.
A couple of months ago, around the beginning of February, Floyd was giving me some pointers to do exactly what he's talking about, the low delta condors. Although he's given you a lot more information here tonight than I started out with. He's been a good teacher. In any case, so I started doing these just really beginning of February, end of January, and went through a whole learning process in February and March. And then April, things started clicking for me. So I really started making money consistently. In April, for the first 20 days, I was profitable for 18 of those days, which is way better than any investing I've ever done in the market in terms of consistency. One of those was a bad day, but the other, it was just very consistent doing exactly what Floyd's talking about, especially low. I was doing 5 delta iron condors at that point, and then later in April, I just went with 3 delta condors with 30-point wide wings. It was just like phenomenally good for me. No matter in April, there were days that were crazy volatile and days that were flat. And it was all clicking until the last day of April when I had a $75,000 account. I grew that account. I think it was up like 12, 13, 14% for the month in that account where I was only doing these trades. On the last day of the month, April 30th, I had a couple of failed trades in the morning. One thing that was good for me, why I was so consistent at making the profits during the overall, is that I had more losses during any individual day, but I would keep the losses small, just a couple of percent, and then trade again. I like closing out the whole iron condors because I get all my buying power back. That's one of the big advantages of just closing out the whole iron condor. Then I can reuse that buying power continually more each day. as opposed to closing out one leg, then it's all my buying power for that other half of it is still locked down. And on the last day of the month, I had a couple of losses in the morning and I got a little greedy. It's just like a little bit of revenge trading. Like I want to finish up on the day. 18 out of 20 days profitable. I want to make it 19 out of 21. And so I was looking back at it like, is this a little bit of revenge trading? Asking myself, but I put down the trade. And in the afternoon, things were going so well. I put 3 of them on simultaneously, all with different strike prices. I've been using the stop limit orders for my stop losses. Things were going so well. The market was just flat. It was just going perfectly. So I had 3 of them on simultaneously, all different strikes. And I didn't put any stop limit orders on. Like potentially this could be really dangerous. And it's always worked out before. And with about 15 minutes to go, the price started going up. These were only like 6 or 7 contracts for each iron Condor. So I'm looking now, like the risk was, max loss was about, I had 4 of them on simultaneous actually. So each max loss was about 15 to 20,000 on each one. Actually, I went off of that account with the 75,000. I went to my bigger account and I was doing them on there. So then for 10, 15 minutes to go, just when you think, okay, which is usually when the premiums really start dropping. And if you're out of the money, the premiums go down to 10 cents, 5 cents, super quick around then. But it kept raising up and getting close to my stop. And it's always turned around and I said, oh my God, it's not. I got out of the first one with just like $1,000 loss. But that delayed me getting out of the others. And I panicked and I made a mistake, bought one and sold one instead of closing one out. That one cost me another $1,000. At the end of the day, I lost $9,700 after having made $8,000 for the whole month. So I lost more than everything I had made during the month of April in 15 minutes. And I'm still getting over the effects of that now. So I've lived both good side and the bad side of this with a consistent winning and earnings throughout a month, and then have it all go wrong when I didn't put in my protection. I denied that this thing could still keep going up. Then I was panicked trying to close these things. And I closed them all out. My total risk on those 4 trades, because one of them was a mistake, was like maximum loss would have been 64,000. So I got out with $9,000 loss. So much less than even what it could have been, because ended up 3 of them finished in the money. But it would have been much worse if I hadn't got out as slow as I did. I am using stop limit. I'm doing exactly what Floyd was talking about. Every trade I've done since then, I'm doing an OCO order with a stop limit order, just like he was showing, and a regular stop order in case that stop limit order doesn't get filled. So he was showing if you sell the contract for $1 and then put in a stop limit order where the stop's going to occur at $2 and your limit is $2.20. If it's moving fast, potentially it could jump right over that $2.20 and never get you out. So the other way is to put an additional OCO order, like true stop order, to get you out, say at the $2.40 or something. That's just going to trigger and get you out at the market price immediately. And it's going to be a bad fill, but it's going to prevent you from having a disaster. Like for me,
Is that what happened that day? You got skipped because of the limit? Skipped the stop.
My big mistake was I did not put any stop orders in. I sold those contracts for 50 cents and 65 cents and sold them at $3, $5.65, and $6.75, way beyond what a stop loss would have been. Just in 5 minutes, it went from $1 to $6. So that's how fast it can change. So that's why I'm doing stop limit orders for everything now. And I'm experimenting with what Floyd talked about with the taking profits, Tom Sosnoff taking profits. I was doing 30%, but I always have some stop limit orders. Floyd was referencing early on where I think it was Tuesday, I put on the trade and I immediately do the stop limit order now for twice what I got. I got in at 75 cents, put the stop limit for $1.50 and got knocked out in 6 minutes. The price of SPX didn't change that much, but the option price did, way more than normal. So I took the loss there. Looking back, I just have to chalk that up to percentages. The percentage, the low deltas, the big advantage for me is that these super low deltas like 0.03 give the opportunity for a high percentage of wins. And so you got to know there's going to be losses in there and they might be bigger. But it all depends on what you set as your stop loss. And that's up to the individual person. There's a balance one way or the other, right? It's never a cut and dry. There's a spectrum. If you set a high stop loss, it may get you out less of the time, but you'll take a higher loss. And if you set the low one, Floyd was on one of Floyd's slides, that's just a few cents above what you received in it. It's going to trigger more of the time, but you're going to have smaller losses. So it's always a balance. So that's what
Also, like since April had a higher volatility, you might be making more income versus in a normal market when VIX is below 15 or 18, then your income for the day would be lower.
I also had higher rates of success during the higher volatility. And in February, we had really low volatility, and I also had high rates of success. So with the
Right.
deltas, that kind of evens that out.
I meant when the volatility is low, you have a higher percentage of winning, but then the volatility is high. That's when you make higher income.
And when the volatility is low, you're not going to get very much premium compared to when the volatility is higher. But I'll share an experience I think it was in early to mid-April when volatility was pretty high. I had an iron Condor and the body was $700 wide. Unbelievable. Now under the current volatility scenario, I'm lucky if I can get the body $200 wide or $240 wide. It's a very dynamic market out there. I know we're getting beyond our time here, but I really appreciate you shared a lot more than maybe some people would, but hopefully you're sharing help folks out there. Is there any other questions?
Yes, both Rick and Floyd, would you like to share how you handle April 9th, the day that it went up 10% with the Trump announcement?
I can look at my record. I just traded put spreads and call spreads. I think it was moving so much. And I
don't know what happened. On April 9th, I made a significant profit.
I had losing ones at the beginning of the day and then 3 put spreads at the end of the day that all expired worthless. And I was up on the day a little bit, but Floyd's the mastery.
Yeah, I had a very good day on April 9th.
With iron condors, not with put spreads?
I did 2 bull put spreads. I did 3 iron condors, and every one of them made a profit.
Wow.
I did the bull puts at the beginning of the day and the iron condors later in the day. It was probably my 5th or 6th best day in April. I think the day that Rick had these challenges, wasn't that the day that Fed Chair Powell spoke?
I had one other bad losing day in April 16th. I think that was the day I also took a big loss because I didn't get out quick. I was just really slow to get out.
So guys, just for the sake of
Yeah.
time, we still have 32 people hanging here with us, and a third of those people are on the East Coast. Any other questions? My email address is on the bottom of the slide, tqqtrader@gmail.com. If you have a particular question, you can send it to me. I'm a pretty busy guy, but at some point I'll answer it. And also, the recording will be distributed no later than Saturday, along with a copy of these slides via the Meetup website. And so if your Meetup membership is current and set up to receive messages from me, you'll receive the recording and the slides.
I have a question. I'm assuming that you're in TQQQ right now. When did you get in? I joined late.
I bought TQQ 3 different times in April. My best price was $46.50. My highest price was $50.50. And then on April 22nd, I bought FAS at $125. But I'm pretty heavy into TQQ right now, and I'm watching it every day like a hawk. But the stochastic line, the fast line is way above the slow line, and it would take multiple down days before we got a sell signal on TQQ.
Or are you trading the week?
Yes, I'm doing the weekly strategy, yes.
Yes.
I'll admit I cheat a little bit. I don't always wait until Friday. If things are looking good, I may buy on Wednesday, hoping I get a better price than Friday. I'd say half the time I'm right and half the time I'm wrong. If I'm wrong, I'll just sell and take my loss. I don't always wait until Friday to make my decisions. even though I'm following the weekly strategy.
Did you say you're half position or quarter?
I'm all in on TQQ right now. I'm probably half position on FAS.
Okay, thank you.
Thanks for sharing your zero DTE. That's a good strategy.
Appreciate the comment. Thank you. I was very nervous about sharing tonight's presentation because of the inherent risk involved. And I hope everybody heard me talk about risk more than 2 or 3 times tonight, because if you don't understand the risk, you have a potential of losing many thousands of dollars. If you understand the risk and can manage it well, you have potential to make some very large dollars here.
Listen, if they don't understand the risk, they need to listen to me. I've been there. I've had to burn it into my brain. Risk first and zero DTE. Yeah. If you don't know the risk, you'll learn the risk.
You'll look like the guy in the right on the
Yes, you
cartoon.
will. I looked at that guy.
Me too.
Yeah, that means you experience some pain trying to pick up a few nickels off the ground.
Yeah.
So
And for me, it's not only
the other advice, if you never traded a zero date SPX, start off with just 2 or 3 contracts. Don't be greedy. Don't try to go in big. Do 2 or 3 contracts, gain some experience, maybe do that over a period of at least a couple of weeks before you finally graduate up to 5 contracts. Do that for a while. If you're having success, you're learning the ins and outs of this thing, maybe you can graduate up to 7, 8, 9 contracts. Please don't try to trade like I do. You have to figure out what works for you. That's very important that you figure that out. And it's true for individual stocks. That's true for ETFs. That's true for life.
go up incrementally. And I think the last point I wanted to make was not only do you have to know the risks, but with this game of zero DTE, you have to be very consistent. You have to consistently act on those risks. One mistake, you could lose a lot. You have
Yes,
to be very consistent.
yes. If you got a trade going against you, you don't have any ego, you don't have any pride, you don't have any reason. Just close the darn position down. Just don't say it's going to get better or I'm a smart person, it'll be okay. If it's time to sell, just sell the sucker. You always can survive with your money onto another day.
Totally.
What's the best way to roll it down? Do you do it at the same time or you buy or sell different
Well,
time?
If I have a bull put, which means I have a short put and a long put, I go to my order ticket and I say roll. It will bring up 4 positions, my existing puts, and 2 more positions. Typically, it will show up for the next day or next week. You have to go to the calendar function and change that so you're rolling on the same exact day for both of your positions. And let's just use easy numbers. Let's say your puts are 100 and 110, and you want to roll them down, then you can roll them down to say 95 and 105. And it's the same day, and maybe it says it's going to cost you 20 cents to do that. And if you agree to that, you hit execute and see if it will execute for you. And if it does, your old puts are gone forever and your new lower strike price puts are now in play. Does that answer the question?
And you have to pay the difference.
If you're rolling, you're picking, the only reason you would roll is you want new strike prices. If it's a bull put, you want lower strike prices on your bull put, and they're going to charge you 10, 20, 30 cents for the privilege of doing that. Am I maybe not understanding your question correctly?
Okay, so you do it simultaneously.
We have to.
I think she's right. It is the difference between the two. You're going to sell your existing one or you're going to buy your existing one. Sometimes
You're going to close. You're going to do a closing order on your existing puts, and you're going to do an opening order on your new puts, and you do those simultaneously.
and you probably pay more than you receive for the new ones. You know, almost or
Typically, when I roll, it's 15, 20, 25, 30 cents. So if my original position was sold at $1 and I can roll for 20 cents, I still have 80 cents of premium left to make money on. So did that clear things up a little bit, I hope?
Yeah, thank you.
But when you go to your order ticket, make sure that you're rolling on the same day. You do not want to roll to the next day. No.
I've made that mistake.
Now, if you have an individual stock, and let's say you have a covered call and you have so let's say you have 100 shares of IBM or whatever it is you have, it's okay if you're going to roll that option, it's okay to roll it to a different date. That's a whole different ballgame. The only time you want to roll to the same date is with the 0 date options. Okay, we've gone over here. You've got my email address. Thanks everybody for great questions and best of success to you. And remember, understanding and covering risk is more important than making a profit. If you cover and worry about risk properly, the profits will follow.
Floyd, one quick question I wanted to ask you.
Yes?
This market, I've been extremely cautious because of one word about tariffs coming from Washington. The entire game seems to change. How have you managed the situation, Floyd?
My main way of managing it is going with deltas of about 2.5 or 3.5, which means I have a very wide body on my iron condor. And I would say having a low delta, wide body iron condor probably takes care of 75% of what you're talking about. And the market will go up a little bit, it'll go down a little bit, it'll go do crazy things. But if my body is really wide on my iron condor, all of that volatility and price changes is still far away from my short call or my short put. The people that are going with the higher delta option, they're getting stopped out or they're closing their positions very frequently. My goal is to adjust or close a position infrequently. And that's why I say I'm a chicken trader. I'm okay to sacrifice some of the profits to have a safer position, if that makes sense. So I would encourage you, even if you just want to do some paper trading, like tomorrow morning when the market opens, pull up a bull put or a bear call or an iron condor and see what kind of premium you can earn if you want the delta to be around 2.5, 3, 3.5, probably no higher than 4, and just play a little bit of what if and say, okay, looks like I could earn about 80 cents with the following strike prices, and then follow it during the day. And like today, you would have said, wow, I would have made maximum profit. Does that make sense?
Yeah, thank you.
I've enjoyed this tonight. I always enjoy sharing things with folks, and I hope that you found some value here. And Haley, I just want to say thank you with the bottom of my heart for stepping up and saying, step aside, Floyd, the old man. It's time to move away. I'm the new leader. And thank you for doing that.
Thanks, Floyd. Enjoy your summer.
Okay, buddy. Appreciate it. I'm going to sign out now. Yeah.
Would it be possible to hear from Haley about his current positions before we wrap up?
Sure. If Haley wants to share, it's up to him. Go ahead, Haley. You're on mute. Haley, wake up. Haley, you there? He signed in and he's on mute. Maybe he's off getting a sandwich or something.
Floyd, can I ask you another quick question while he's coming?
Sure.
People have been talking about the 3 legs down. As I look at other indexes, for example, MDY, IWM, and RSP, I see a clear 3 legs down. Have you considered that we may have reached the 3 legs down in the general market based on the action of the Russell, the mid cap, and the RSP?
Yes, the answer is yes. And that's why I'm in heavy on TQQ. It's why I've got a position on FAS, but I'm willing to admit I'm wrong. If we do a turn and I get a sell signal, those babies are going to go to cash.
Excellent. So you see 3 legs down, you're comfortable.
Yes, I am. I'm very comfortable, but I tell you what, I don't know if Ralph, if you've looked at our levers ETF stochastic strategy, we don't worry about 2 legs, 3 legs, 4 legs, whatever. We look at the stochastics, and this is not using market surge. You cannot use market surge stochastics to trade these levers ETFs. We have basically a time step of 5, whereas market surge uses 14. You get a buy signal on the TQQ, I'm going to buy it, and I don't care what all these other indicators are telling me from our back testing. is telling us if we buy on the buy signals and sell on the sell signals, we're going to make money.
Did you get a buy signal in the middle of March then?
Let me do a quick look because
Should have been early April.
The first buy signal was about April 8, 9, 10. We did not get a buy signal in March,
Okay. So you're using a different stochastics than I was using.
the weekly.
Okay.
Put both.
Let me clarify. The way that Gary has taught me how to use this, we're using a daily chart, but we're using the weekly calculations on the stochastics. If you look at TradingView, the stochastics looks like a step function because they calculate those once a week. Now, some people trade the stochastics on a daily strategy, and that's fine. I don't like to do that because if you're trading the daily strategy, you're going to make about 5 times as many trades as I do. You may make more profit, but my personality doesn't like to do 5 times as many trades.
I understand. Thank you.
I'm happy to share, Ralph.
I can add on what Floyd is saying there, because I'm looking at both the daily stochastic and weekly stochastic on Thinkorswim. The daily would have gotten in on the big day on April 9th. That was also the buy on the daily stochastic, as well as that same week was the buy on the weekly stochastic.
Haley's still on mute. I don't know what happened.
Haley said in the chat, I need to step away for a minute. My apologies. I'm unable to speak at the moment. That was 5 minutes ago.
Okay, we've been going for 2.5 hours and I haven't had dinner yet.
Yeah.
So I think we'll just close it out, and I'll let Haley know that maybe he can post through a chat or something what his current holdings are so we can get that one question answered. Excellent. Thank you, everybody, for hanging in there with us. We're looking forward to this being a good month, but like IBD and Bill O'Neill said, we're not in the predicting business. We're in the reacting business. We'll react to what the market hands us, and I hope the market hands us a great May, June, etc., but we'll just see how it goes. And who knows how many crazy things are going to come out of Washington, D.C. and out of Russia and all the other crazy places. And my experience has been I lived through the Cuban Missile Crisis and the assassination of President Kennedy. So if world events would make you fearful, you would never be invested.
Yeah.
So thanks, everybody.
Thanks. Thanks, Haley. Thanks, Floyd.
Okay, signing off.
Bye.